Welcome to Alpha Recap, your aftermarket wrap from stockalpha.ai. We're coming to you with the highlights from today's breaking analysis recap. As always, if you have questions, you can reach us at stockalpha.ai and use the Q&A feature to ask directly. Ready to dive in?
Absolutely. Big day to unpack. Markets closed with a pretty cautious tone on July 20th, and there was a lot moving under the surface.
So, what really stands out here is the mix of geopolitics, rising yields, and a narrow group of megacaps doing the heavy lifting. Those three threads were pulling on the market all day.
Right, and the geopolitics piece was front and center. Tensions in the Middle East pushed oil to one-month highs, and that spilled into travel names and risk sentiment more broadly.
We saw oil move higher because of weekend strikes and a Houthi blockade that analysts said was disrupting shipping in the Red Sea corridor. That wasn't just a headline, it fed into insurance and fuel costs for airlines.
Ryanair was an example of that. They reported a 34% profit decline for the first quarter, and the stock slid roughly 6%. Not a great update for airlines. And Domino's actually outperformed after beating revenue expectations by about 2.5%, which shows top-line resilience in parts of consumer spending despite higher input costs.
PepsiCo, by contrast, hit a 52-week low, around $134.65. So you could see divergence inside consumer goods today.
Yeah, that tracks.
Another big theme was Treasury yields. Reports varied on the 10-year. Some cited it near 2.9%, others at about 4.56%. The discrepancy looked confusing, but the consistent takeaway was that yields were higher and moving in response to risk.
Exactly. Timing and data source differences explain the math, but higher yields matter mechanically. When yields rise, the present value of future cash flows falls, and that compresses the price-to-earnings multiples for long-duration growth names.
Put simply, growth stocks that promise earnings far out in the future get hit harder when the discount rate ticks up. Income and value names suddenly look relatively more attractive from a carry perspective.
So honestly, I was a bit surprised by this one.
Tell me more.
The market still showed some optimism because earnings season kicked off with an unusually high early beat rate. Bank of America flagged that about 88% of the 50 S&P 500 companies that reported so far beat expectations. That's a striking stat for week one.
It is striking. But the nuance is critical. Beats can coexist with cautious guidance. Companies might beat near-term numbers, yet warn about margin pressure from higher commodity costs or weaker demand going forward.
Right. And the other thing is institutional flows were a big story today. Upslope announced a Q2 reshuffle where they added Magnum ice cream at about $15.29 and exited legacy names like Intel and Hershey.
And Stanley Druckenmiller materially reduced Alphabet exposure and redeployed into a single S&P stock that, get this, was reported up about 3,200% over the trailing year and was trading near $175.
I mean, when you step back and look at this, those moves highlight how concentrated momentum can be. Big reallocations like that can amplify intraday swings and change thematic exposure quickly. There were also technical and ecosystem shifts. NASDAQ made some index methodology changes, and Samsung launched a U.S. credit card on the Visa network. Small things, but they reshape flows and positioning over time.
Which brings us to market breadth and concentration. Analysts keep pointing to the so-called Magnificent Seven, those megacaps tied to AI and large growth, and how they were the engine for index gains, even as breadth stayed weak.
When a handful of names are carrying the market, indices can look healthy while most stocks don't participate. That narrows liquidity and raises a fragility risk. If leadership stalls, the index could correct sharply.
Short reaction.
Right.
We should also talk about semiconductors. There was a split view between big banks. JP Morgan suggested a tactical buying window this summer, while Morgan Stanley warned of a tougher second half of 2026.
That's an important debate because chips are the plumbing for AI exposure. If hardware spending slows, the whole theme could underperform. If server and infrastructure spend continues, charts could look very different.
Traders need to treat those as scenarios rather than a single forecast. Inventory dynamics, end market demand cycles, and cadence of upgrades all matter. Let's shift to implications. Who was affected and how people might think about this backdrop. First, traders and tactical allocators saw elevated intraday volatility driven by yields, oil, and headline reallocations. That can create opportunities, but it widens bid-ask spreads and execution risk.
Long-term growth investors were being reminded to reassess duration risk. Higher yields mean you should stress test valuations under a higher discount rate scenario, and think about how much concentrated AI exposure contributes to total portfolio volatility.
Income and fixed income investors saw rising treasury yields as both opportunity and caution. Higher yields can improve income profiles for laddered strategies, but they also signal higher borrowing costs for corporates, so duration decisions mattered today.
Thematic AI investors were getting a message too. Big banks offering alternatives to the concentrated AI trade underscore crowding risks. The chip debate, JP Morgan versus Morgan Stanley, was basically about timing and inventory rather than a pure data contradiction.
Travel and consumer cyclical exposure was clearly impacted by geopolitics and fuel costs. Ryanair's profit hit and PepsiCo's low show how margins differ across businesses, even when revenue looks resilient in places like Domino's.
Quick reactions. Understood.
For anyone thinking strategically, analysts said to keep an eye on a few consistent signals. Real-time yields and Brent crude for geopolitical de-escalation. Breadth indicators versus index moves. Forward guidance in earnings reports. And institutional flow signals like 13F filings and block trades.
And be mindful about conflicting macro signals. Reporting differences on the 10-year yield and the chip sector split highlight why timing and source matter. Build scenarios: higher yields, higher oil, sticky inflation, and test portfolio sensitivity to each.
A simple way to think about it. Headlines moved markets, but under those headlines, the needle was being pulled by three forces: geopolitical risk, concentrated megacap leadership, and an early earnings picture that was positive on beats but mixed on guidance.
I mean, when you step back and look at this, that combination creates an environment where indexes can climb even as breadth stays narrow. And that's a classic fragility signal.
Let's wrap with clear takeaways. 1. Geopolitics pushed oil and risk premia higher, which translated into pressure for airlines and some consumer names.
2. Treasury yields moved up, and that mattered for long-duration growth names. Higher yields compress future cash flow valuations.
3. Market leadership remained concentrated. Indices were buoyed by a few megacaps, while breadth stayed weak. Watch that closely.
4. Earnings season started strong, on beats, about 88% early beat rate. But forward guidance and input costs will be the real story to read.
5. Institutional reallocations, like Upslope's moves into Magnum ice cream at about $15.29, and Druckenmiller's switch into that hyper-momentum S&P stock near $175, can amplify short-term volatility.
Bottom line, analysts note the market was being driven by a convergence of geopolitical risk, concentrated megacap leadership, and mixed early earnings signals. That combination rewards clarity on time horizon, liquidity tolerance, and sensitivity to yield and commodity moves.
If you're passing the day, verify real-time prices yourself and consider scenario tests. This recap is informational only. We didn't and won't offer any buy, sell, or hold advice.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back after the next market close with more context and analysis. Take care, and don't forget, questions at stockalpha.ai.